I'm going to show you the asset allocation you need for your retirement investments using a case study of a $4 million portfolio and the exact steps we took to build Paul and Susan's plan. I see far too many people miss the most critical element when designing their allocation. They rely simply on age and risk tolerance. And while those are factors, this often leaves people investing too conservative or too aggressive. Both carry risks, and the danger is that you fail to get the most out of your hard-earned retirement savings. So meet Paul and Susan. They're both 64 years old, and they're getting ready to retire in 1 year at age 65. Their goals are to design a retirement income plan that meets their needs and sustains them over the long term, save taxes, travel, give charitably, and spend more time with their family in retirement. They've built up a solid financial base with $4 million in investments, and if you've saved more or less, this framework can still work for you. Here's how this breaks down for them. Okay, so they have a taxable brokerage account worth about $950,000. About half of that is capitally appreciated. Susan has a traditional IRA worth $600,000 from a prior rollover. Paul has $2.2 million in his active pre-tax 401k, which he's still contributing to. They've also built up $250,000 combined in Roth IRAs. Qualified withdrawals will be completely tax-free. And their home is valued at about $1.2 million here in Southern California. And it's completely paid off, so they don't have a mortgage to worry about heading into retirement. Now, we'll come back to these accounts in a minute because the tax character of each one plays a big role in which accounts they should withdraw from first, and then how we ultimately build their asset allocation. But let's first talk about income, because this is where the planning starts to take shape. Both Paul and Susan are in good health. They do plan to delay Social Security until age 70. That gives them larger monthly benefits and also a 5-year window to draw from their portfolio and carry out some tax planning while keeping their taxable income very low. I'll show you how they benefit from this. Now, Paul's benefit at age 70 is projected to be about $4,200 per month. Susan's will be about $3,100. But that won't kick in for several years. So in the meantime, we need to understand how much income they'll need to pull from their investments. They're targeting $11,500 per month in retirement spending. That includes $9,000 for core lifestyle expenses, $1,200 for charitable giving, and $1,250 per month or $15,000 per year earmarked for travel. And if you're wondering how we arrived at those numbers, we didn't guess. We used the Live, Give, Owe, Grow method to estimate retirement expenses more accurately. That's something we cover in detail in one of our most popular videos, Stop Calculating Retirement Expenses Wrong. The reason we use this is most people calculate their expenses inaccurately. Most underestimate. And although it will never be exact, you certainly don't want to be aiming for the wrong income in retirement. I'll leave a link in the description for that video if you want to check it out. But let's keep going because we still want to see how we can save taxes, which accounts to withdraw from first, and how that leads into the most optimized allocation for their portfolio for both income and growth. So when Paul and Susan retire next year, they'll need to start drawing income from their investments immediately. And this is really important to how we design their plan. So let's take a look at what their projected income will look like once they retire. What you're seeing here is the hatchet shape. In the early years, withdrawals from their portfolio are higher, but those withdrawals reduce once Social Security kicks in at age 70. And this reflects that common transition going from a saver focused on building your portfolio to an income taker, someone who still wants long-term growth, but also needs to safely draw income even when the market doesn't cooperate. This is where their withdrawal strategy and how we coordinate their accounts starts to make a real difference. Like many retirees, most of their savings are in pre-tax accounts. Paul's 401k and Susan's IRA total about $2.8 million. That money hasn't been taxed yet, and once RMDs start, those forced distributions could be more than they actually need, triggering higher taxes and Medicare surcharges. So one of the first questions we worked through was which accounts should they withdraw from first? And this isn't just about where the cash comes from. It's a tax planning decision that affects their entire retirement picture. The default order many people use is to pull from their taxable accounts first, then tax defer those IRAs typically, and leave the Roth for last. That tends to save taxes early in retirement, but our goal is to save taxes over their lifetime. So once they retire next year, they'll actually enter what we call a tax valley, a window where their taxable income is unusually low. So we want to be proactive and we want to actually take advantage of it. So we looked at a few different strategies to fill that valley as efficiently as possible. In other words, we're willing to take income as long as it's at low tax rates. And one great way to do this is by converting some of that pre-tax IRA money over to tax-free Roths. We evaluated multiple strategies, and some proposed more aggressive Roth conversions that would save slightly more in taxes, but they required very high conversion amounts. In this case, the added complexity wasn't saving them much more. So we settled on a balanced and sustainable approach, converting just enough to stay under IRMA bracket 1, avoiding Medicare surcharges while still capturing meaningful tax benefits. And you can see the difference here. The yellow bars show what happens with the default withdrawal order. There's a major dip in taxable income early on, but a big spike once RMDs begin. The blue bars, however, show the Roth conversion strategy, where we proactively level out their taxable income and, most importantly, reduce their lifetime tax burden. This is a multi-year projection, and while we know the actual numbers will vary based on tax law, markets, and income needs, this at least gives us a strong direction to plan around. And then based on this projection, the strategy would save them over $700,000 in taxes. Their average lifetime tax rate reduces by 4.6%. That's a major win and important to how we will set up their investment plan. So now that we've kept more money in their pocket by minimizing taxes, the next step is to understand how much income Paul and Susan actually need to pull from their portfolio. Because that's what ultimately allows us to build an asset allocation beyond age and risk tolerance that actually fits them. So I'm showing you their first full year of retirement in 2027. That $11,500 per month that they're targeting is adjusted a bit for inflation. Taxes are low. Outside of those Roth conversions, we'll layer on top of this. So total expenses are about $147,000 for the year. The good news is that they could actually pull over $200,000 from the portfolio if they want to, or they can leave that invested if they decide they don't need it. And if you're quick with math, you'll see that pulling $200,000 from a portfolio, even when projected to grow over the next couple of years, is a withdrawal rate of about 4.7%. What allows them to go above the 4% rule is that we're using a dynamic risk-based guardrails system, one that adjusts based on how their investments perform over time and takes into account other real-world factors like inflation, longevity, and market risk. So what this tells us, if the portfolio grows and crosses the upper guardrail, they can give themselves a raise. If it drops, however, to the lower guardrail, in this case $2.4 million, they need to tighten spending by about $600 per month, at least temporarily. And these numbers will dynamically change through their retirement. We've set their plan with middle-of-the-road risk preference, not overly aggressive on the spending scale, but also not too restrictive. And we've built into their income model $400,000 in today's dollars, specifically for potential long-term healthcare needs down the road. So let me show you how this dynamically adjusts through one of the toughest times, as if they retired just before the 2008 financial crisis. So in their case, they would have nearly hit a lower guardrail in 2008, but then as the market recovered, they would have experienced an increase in addition to cost of living adjustments. So this gives Paul and Susan a disciplined framework, so they don't need to second guess every move. And then all of this, the income, the timing, the stress testing, gives us the information we need to build the portfolio allocation that's tailored to their income needs and then also their growth potential. So now we know how much Paul and Susan can safely spend, when they'll need it, and how their plan can adjust over time. Step one in building the portfolio, before we can even think about the growth side, is that we need to first stabilize their income. Because remember, in the first few years of retirement, they're relying entirely on portfolio withdrawals to fund their lifestyle. Your situation might be different, but that's why the first step in building the portfolio is creating what we call a war chest. A war chest is a reserve of stable assets like high quality, short to intermediate term bonds, cash. Those are intentionally allocated to meet spending needs, especially during times when the stock market may be down. Now, historically, the average bear market lasts about 3 years. But some of the more difficult stretches, like the 1970s, the early 2000s, and 2008, took 6 to 7 years from peak back to peak. So we need to plan for that. For Paul and Susan, we've identified that they want 6 years worth of income in the war chest. So we've earmarked $1.2 million, or 30% of their $4 million portfolio, in stable, high-quality assets. And the nice thing is this can be tailored to your personal risk preference and adjusted as your income needs change. So that gives them 6 years of income already stabilized, with the goal of not forcing them to sell stocks during a downturn just to meet their monthly needs. And here's how that breaks down. 5% of the portfolio is held in high yield cash, enough to cover 1 year of income. 25% is allocated to short and intermediate term bonds to cover years 2 through 6. And then the remaining 70% is invested in stocks positioned for long-term growth. And don't miss this part. That 70% is what we would expect to rock and roll with the market, but also produce the most growth over time. But when crisis hits, that's not money they are going to use, so they can rest easier. Now, this isn't just about hitting a 70-30 target and calling it good. The allocation's intentionally structured account by account based on when Paul and Susan are likely to draw from each one. So in their case, their taxable account, which they'll use sooner, leans more moderate at 60% stocks and 40% in bonds and cash. Their IRAs and 401ks a little bit more growth at 65-35. And then their Roth IRAs are entirely invested in stocks since those dollars may not be touched for many, many years. That kind of structure helps balance the risk and the timing, and we even consider the tax impact when building it. Because in reality, we might go more conservative in that taxable account since that will be the primary income account, but we also have to be mindful of capital gains when selling appreciated stocks, which is why the IRAs are maybe more moderate than they need to be. So we're balancing the timing and the taxes. And we can further adjust based on how income changes and the Roth conversions down the road. Now, altogether, this adds up to roughly 30% of their portfolio in stable assets across all accounts, meeting their war chest goal while allowing 70% toward long-term growth potential. A simple stock and bond strategy can be applied once you have this blueprint. Now, because we have the research and the tools, we also include a layer of tactical risk management within their allocation. It's designed to pursue growth when markets are trending upward, but shift to a more defensive position when trends signal a need for caution. So as Paul and Susan prepare to retire, it's no longer just about maximizing returns, it's about aligning their investments with new priorities, protecting income, managing risk, but importantly, still leaving room for the growth they'll need in the decades ahead. The war chest, the dynamic risk-based guardrails, they give them that freedom. But what if you could actually compare how this approach stacks up against other income strategies? Well, you can. I compare 4 retirement withdrawal methods, including Vanguard's retirement income approach and the dynamic guardrails we used here in this next video you need to watch. And these are the kinds of plans we build and actively manage for retirees. If you'd like to talk with me and my team about your retirement plan, you could schedule a brief call using a link in the description. Thanks for watching.